So our goal today is the options. The last question on the exam, we'll have a team question worth double points on Thursday. So hopefully we'll get through enough. For the exams, these are the ones you have to know. Long call, long put, protected put, covered call, callers, and straddles. It's really a lot easier than most people make it because there's really only one formula you really have to know. If you buy a call, this is the formula. If you buy a put, this is the formula. If you short a call, exact same formula, but you put a negative sign in front of it. If you sell a put, exact same formula, you put a negative sign in front of it. So we're going to get into this, but if you buy a call, your gain or loss at expiration is going to be the stock price minus the strike price. Stock minus strike are zero because you're not going to execute a put option if it's going to lose you money. If you have the right to buy something for 120 and it's currently trading for $100, you just let it expire worthless. So that's why I have the comma zero in there. All right, so you have the stock price minus the strike, comma zero, minus whatever you paid for the call in the beginning. The put, what do you do on the put? You just switch the S and the X. It's the strike minus the stock price. But that's really the only formula you have to know. It's really pretty straightforward. So we're going to do it over and over again. Practice it. So hopefully you in the back can see this, Paul and Kyle. Hopefully I'll try to use big enough fonts. If we need to turn off the lights, I guess we could. It's kind of sunny today. But let's do it doesn't really matter which stock we do. So let's do NVIDIA. So with NVIDIA, the current stock price is 476. So we're going to do a call option. Why do I say long call option? Well, because we're going to buy it. You can sell a call option. That's called shorting it. What if you sell a call option and you don't have anything else going on? Then you're naked. That's short call option, which is really dangerous to short things because your loss is almost unlimited. But if you buy a call option, what's the most you can lose? Whatever you pay for the option. You can't lose any more than that. So that's kind of nice. How far out do we want to go? Let's go out to, well, let's see what our options are. So we'll go over the options. Let's go out to, why don't we do March 2024? We're going to be out of the money, which means the call option strike price has to be what? You're at greater than 476 and be out of the money. How much out of the money do you want to be? Well, NVIDIA is up an awful lot. Sometimes what I like to do is look at the last 52 weeks and see, hey, you know what? They're trading at 100, but they're trading at 140 not too long ago. Man, let me try an option at 120. Who knows? You got to decide. So let's try a strike. Let's see if we can find $500. Do you think it's possible that NVIDIA's stock price could go above $500 between now and next March? You almost did that this year, right? Just practically doubling. So that's possible. So there's the expiration. So 500 in March. So we're doing March. Go down to 500 strike. We got two prices here. 33.65 and 33.95. $65 and $95. So which do you use? And it's so easy. If you're buying something, what do you think? You're going to pay the higher price or pay the lower price? If you're buying something, what are you going to do? Higher. You're going to have no choice. You'd like to buy the lower price, right? But the ask is what you have to pay. The bid is what you get if you sell it. All right. So that's the spread, 30-cent spread. So if you were to buy it right now and change your mind and immediately sell it, you're going to lose 30 cents just because of that transaction. All right. So you always know if you're buying something, you pay the higher price. If you're selling something, you receive the lower price. You don't have to remember bid versus ask. I always get them confused anyway. Just bid is the lower price. So if we're selling an option, here we're buying an option. So we're going to pay the $33.95. And on the exam, we're going to ignore contracts. A contract is 100 options. We're going to ignore that. We're just going to do one option. All right. You can't actually do that. In practice, you have to do what we're doing times 100. So we're going to pretend like we can buy one option for $33.95. In practice, you have to buy 100 of those. So $33.95 times 100 is what you'd have to actually pay. All right. They're traded in 100 blocks, but we're going to ignore it on the exam. The exam says that ignore. I always get that question on my YouTube channel. Well, what about the times 100? And it clearly says ignore that. You can multiply by 100, right? Everything we're doing here, just multiply by 100. So what we're going to do on the exam is we're going to say, let's pretend like it is March 2024. And let's say that their stock price, March 2024, let's say it's $400 or $410 or $600. All right, so let's do the stock gain or loss. All right, Kyle, can you see this? Yeah. All right. And then let's do the option gain or loss. Well, the stock gain or loss, that's pretty simple. You bought the stock for $476 and now it's worth $400. How did you do? So you had your ending value minus what you paid for it. You would have lost 76 bucks. That's really, really simple. We can copy that down. If the stock price went to $600, you would have made $124. All right. So here on the exam, what I'm going to ask you to do is give me the gain and loss on the option. And remember, the formula is, anybody remember it? Max. What is S minus X? S minus X. Remember the option premium. All right. So equal max. The current price is 400. What was our strike? 500, 0. So what are you going to get on the option? Are you going to buy that stock for 500 bucks when it's currently trading for 400? I'll just let the option expire 0. Does that mean you make 0? What did you have to do this option? You had to pay the $33.95. So what's the most you can lose on this call option? $33.95. So we copy that down. At what point will you start making money? What if the stock goes from 476 to 490? Still out of the money. What if it goes from 476 to 500? Would you execute the option there? Probably not. It'd be a waste of time, right? Buy a stock for 500 that you can buy for 500. What if it goes to 505? The option will be worth $5. What did you pay for it? 33. So how did you do? You lost $28.95. What's your break even? What would the stock price have to hit so you make exactly 0?
533.95.
Yeah, so once it hits 500, you start making money. Once it hits 533.95, you should break even. Right there is your break even. All right. So the stock price, if we did a graph of the stock price, it's just going to be a straight line. Nothing interesting about that. When the price falls, you lose money. When the price goes up, you make money, but the put option doesn't look like that. So the put option looks like an apparatus used in sports. Everybody guess what that is? Not a sport we play in San Antonio, but they play it in Canada a lot. Hockey, what does it look like? A hockey puck? No. Hockey stick, right? So that's what a call option looks like, is a hockey stick. Does that look like a hockey stick? That's the call option. Right? Remember this when we do the protected put. Guess what the protected put looks like? It's like the exact same hockey stick. We'll talk about put call parity on Thursday, hopefully. But that's what it looks like. The most you can lose is the 33 bucks. So on the downside, you know your max loss. That wasn't true with the stock, right? With the stock, you could lose a lot. You lose all of your money. So with the stock, you can keep losing money if the stock price falls, but with the call option, the most you can lose is the $33.95. On the way up, you don't make as much money as you do with the stock, but remember with the stock, you paid $4.76. With the option, you only pay $33.95. So the call option, your dollar gain won't be as much, but your percentage gain would be much, much larger. Because you got to pay $4.76 for the blue line, you only pay $33.95 for the orange line. All right. So that's the underlying on a call along on a call option. Very common shape. And so those, since Riley's in my life insurance class, you remember the equity annuity? Look exactly like this. So there's a pretty common shape. People love this shape. Why? Because it's like insurance. The most you can lose is like your auto insurance. The most you can lose is what you pay for the auto insurance. But if you wreck your car, you get to sell your car for a huge gain. A car that's worthless, you get to sell it to the insurance company for 20,000 bucks. So it's a pretty common approach. This is a lot like what insurance looks like. People like cutting off the tail of the distribution, so don't have all that downside. All right. What about a long put? So a long put, we'll do the same expiration. So now I want to do out of the money. So the put strike has to be what? Less than 4.76. All right. When you're doing a put, you're out of the money when you're below the current stock price, because you're talking about what you can sell it for. All right. So let's go. Boy, this is going to be expensive, but let's do 450. Let's go find the premiums at 450 for the puts. So it's going to be out of the money, 450. $25.50, $25.70. We're buying the put, so what are you going to pay? $25.70, right? You're long to put. So let's go to expiration of the option. Let's say it's trading for, we'll do the exact same scenarios. So in this case, if it falls to 450, how did you do? The option's worthless, 450 versus 450, but you paid $25.70. So where's your break even on this one?
424.30.
Yeah, so here you take the strike price minus what you paid for it. Once it hits 424.30, you're making money. All right, so the stock gain is exactly the same as before. We take the ending price minus what we paid for it. So that looks exactly the same. The put gain or loss, remember the formula, it's max, but this time it's X minus S and 0 minus the put premium. All right, so you only have that one formula, so you just have to know whether it's S minus X or X minus S. So calls, it's the stock price minus the strike. Puts, it's the strike minus the stock price. Real simple. So equal max, the strike 450 minus that. So how do we do in this one? That looks pretty good, right? We can sell it for 450. It's only worth 400. We're gonna have a $50 gain there, but we had to pay $25.70 to get it. So there we have a gain of $24.30. We said our break even was whatever I said it was. $24.30, $4.24. So there's our break even. All right, the stock price looks the same. What apparatus in sports does this look like? Looks like a hockey stick again. It's just upside down, right? It's not radically different. Well, not upside and backwards. It's a left-handed, I guess, a left-handed hockey player. All right, so there's the put option. The most you can lose on the put option is what you pay for, the $25.70. That's a very bearish strategy, isn't it? You make money when the stock price falls, and you lose all your premium when it prices. All right, so it's a hockey stick, but going in the wrong direction, or maybe it's laying down on the floor or whatever, but it's still hockey stick. All right, so there's a long put option. All we've done is use this formula right here and this formula right here. How much easier can you get on an exam question? All you have to do is just calculate that. Now, I'm doing this at expiration. We'll talk about time value hopefully today. We may not have time to do time value, so we'll see who can get time value on Thursday if we don't cover it until Thursday. But at expiration, time value is 0. So this is the value of an option at expiration. But before expiration, it will be worth more than that. So that's the value at expiration. If it trades for more than that, the difference is your time value. So that's really important when I ask about time value on the exam. You know the intrinsic value of the option is this formula right here. It's max S minus or X minus S comma 0. That is the intrinsic value. You compare that the option premium, any difference is time value, but we'll get into that. We do time value. All right, so long a call option, very straightforward. Long a put option, very straightforward. So now we'll start combining them. So the first one, which is really popular, is a protected put. And it's going to look very similar to what we just did with the call option. Almost, in fact, mathematically, it's the exact same thing, except for interest rates. So a protected put, anybody know what a protected put is? Anyone seen a protected put before? So I'm going to bring this over. So protected put, you're long the stock and long the put. So you buy the stock and the put. Essentially what we're going to do is we're going to combine these two pictures. What's going to happen to this side of it? It's going to even out. So we're going to cut our losses. And then what happens up here? This line is just going to shift down, isn't it? By that. So when you combine them, it's going to look a lot like that. But let's see if it does. It's going to look like the exact same. So a protected put and a long call is practically identical. We'll see that when we look at put call parity. All right, so we have the stock price at 476. We have a put expires in March that has a strike of 450. We're buying the put. We're long the put, so we're going to pay the ask. the higher price. So at expiration, the stock gain is going to be the ending stock price minus what we paid for it. That's the same as before. The put is the max of the strike minus the current, comma 0 minus what we paid for it. So what's the protected put? You just add those two things together. And you'll want to see another hockey stick. Looks just like that call option, doesn't it? Another hockey stick, protected put. So what happens on the downside? On the downside, you lose money, but not as much as you might have lost. So let's look at 420. So at 420, how did you do on the stock? You lost $56. Everybody agree with that? Right? You bought it for 476. It went down to 420. How much is the option worth? It's the max of 450 minus 450 minus 420. So you made $30 on the option. And then what did you have to pay for it? $25.70. So did the option help you here or hurt you? Oh. Helped you a little bit, right? If you'd owned the stock, you would have lost 56. Because you have the option, what are you going to lose? 56, but you're going to get $2.30 back from the option. You paid $25.70 for it. You got 30 back for it. So you lost $51.70. What if it was 400? You see, it doesn't matter at the bottom. Why does this stay fixed? Because as the stock price falls, your gain here is minus 76, but your option premium, your loss goes up another 20 bucks, but your put option gain goes up 20 bucks. So at some point, every dollar you lose on the stock is exactly offset by the gain on the put. So at some point, you have your max loss. What if the stock fell to $10? What would you get? What's going to be right here if I type 10 there?
51 cents.
Negative 51.7. That's the max you can lose. And people love that. They say, wow, you're telling me the most money I can lose is 57. It doesn't matter if the world comes to an end. Now, if the world comes to an end, hopefully the Chicago Board of Trade option exchange will still be working. But if something horrible happens, you know, if you bought in Lehman Brothers in 2008 and then a put option on them, you know, the most you could lost was that, even though the stock went to 0. So it gives you that, you know, your max loss that you can have. I wish Bill Gates would fix this.
The return has to be higher for the protective put, right? Since the most you can lose is more than the call
What do you mean has to be higher?
Because the call option, the most you can lose was like 30 something, 35.
Well, let's talk about it, because I was going to wait till Thursday, but I think we have to do it now. I don't remember where I put it though. There it is. This is one of my favorite parts of finance, is put call parity. So put call parity is not a theory, it's a mathematical formula. What put call parity tells you is a call plus, it's a little bit tricky to get the nomenclature. So the call, if you buy the call premium, that's C, plus a bond invested in a risk-free asset,
that matures exactly at the strike price. That's what that PVX is. That's a bond. So if you bought a bond, so our strike price was $4.50. You want to buy a bond today, maybe at $4.48. That's going to mature exactly at $4.50. That has to equal the expiration. That has to equal the price of the put plus the price of the stock. Those two things have to equal each other. They have to equal each other all the time, but they have to equal each other, assuming that your strike is the same. That's called put call parity. If that formula is not correct, you can make an arbitrage gain. So if the left side was $100 and the right side was $98, you could buy the right side, sell the left side, and have a $2 gain for sure, without any risk. How much would you invest in something that's a for sure gain of $2? So how much is your investment? You sell it for $100 and you buy the other one for 98. So how much is your initial investment? You made $2. So you brought in $2. You know, in 3 months, that's going to be worth 0. So you make $2 and in 3 months, you don't have to do anything. So you get $2 a day. How many contracts would you do today? You get $2 for contracts a day, and in 3 months, you don't have to do anything. Would you do $1,000 worth? Would you do $10,000 worth? What would you do? I do $17 trillion. My broker would let me.
All right, so those have to be equal. If they're not equal, now are they ever not equal? Well, it's really hard for me to show you because the strikes have to be exactly the same. And it's hard for me to get the strikes exactly the same because what's the possibility NVIDIA is going to be trading exactly for $450? I can do this. It's really hard. I've seen a few times. There's one time where I did Nike and they were exactly at a strike price. So I could actually show put call parity, but it's hard to show it because it's hard to get that. But if you find that, you can make arbitrage prices profit. There are hedge funds that's what they're looking for. And they're looking for fractions of a penny. But this thing will get off a little bit. But so that's what it is now. You can switch that around. So I like to think of it as a call plus a bond equals a put plus a stock. So that means a call is the same thing as buying the put, buying the stock, and borrowing money at the risk-free rate. It's the exact same thing. Or, this one's really interesting, buying the stock is the same thing as selling the put, buying the call, and buying the bond that expires at the expiration price. So you can set all those up. Here's another way at the bottom that you'll often see it. C plus DK equals P plus S. The DK is a bond today at the risk-free rate. You don't want to take risk in the bond because that messes it up. So bond at the risk-free rate that matures at the strike price equals a put plus a stock. Or if we ignore the bond, what does this say? A call is the same thing as what? A put for plus the stock. What did we just do with a protected put?
You bought the stock and
Yeah, the right-hand side, right? So you can see the call. So out there, there's the answer to your question. The difference is interest rates. It's whatever that interest rate difference is that's what's going to cause the difference in the two strategies. And remember on interest rates, the call gives you the advantage that you buy the call, you don't have to buy the stock. So you're saving interest. The put, you have the disadvantage that you're buying the put instead of selling the stock. And so you're losing out on interest. So that's the difference between interest rate. But y'all see now why those two charts look exactly the same. They're essentially the same. That's what put call parity is. I encourage you to look it up because put call parity, Wikipedia does a pretty good job on it. And this is what finance talks about replication. If you can't buy the stock, you can instead sell the put, buy the call, and have a bond, invest in a bond portfolio just enough to hit the strike. And it's exactly the same as buying the stock. Exact same thing. So I don't know anyone would replicate a bond doing this. That'd be kind of bizarre, but you could replicate everything else. That's what replication is. You have the security you want to buy, but you can't buy it, but you can replicate it with these 3 other securities. And they're exactly the same. You end up with the exact same transaction. So look up on Wikipedia. I've given you a couple of things here, really, really interesting parts of finance. So put call parity. See the formula here? That formula now makes sense, right? It's not that difficult a formula. Wikipedia. And they're flipping it all over around in different ways. And they have some pretty good links. And then the other thing I was talking about was replication. Not computing. So you got to find, you have to put it in the investment room. Replicating portfolios. So that's another interesting concept. This is not that uncommon for firms to do this, especially investment banks. They'll do these structured notes. A real popular structured note is your entity is not allowed to buy stocks, but you can buy a AAA bond. And so I remember Lehman was selling these things in 2008. So you can say, hey, we'll sell you this bond. It's AAA rated. Your coupon is the S&P 500 return. So if the S&P is up 10%, our coupon is 10%. If the S&P is down 10%, the coupon is negative 10%. From their policy standpoint, regulators, it looks like they have a AAA bond, but they don't. They actually have the stock market. So they replicate that. So replication is pretty popular. So you can see some of the things they have. Wikipedia does a pretty good job of giving you some pretty decent links that you can look at. All right, so call, long call, S minus X comma 0. Long put, X minus S comma 0. Protected puts, you got the value of the stock, which is the ending stock price minus beginning stock price, and then you put the X minus S comma 0. Covered calls. Anybody know what a covered call is? So covered call.
Is it longing or shorting the stock and longing the call?
Close. Say that exactly the opposite, and you got it. Sell the call and buy the stock, right? It looks like a really horrible strategy, but I'll show you when you might want to actually do this. It can make a lot of sense. Okay, so covered call, you're long the stock and short call. Now we're short the call, so what premium are we going to receive? When you get the bid, right? If you're selling the call, you get the bid. So there's our stock price. All right, so the gain on the call option is the same as before, equal max. Is it S minus X or X minus S? It's a call option. S minus X, so the stock is 400. Current value, strike is 500, comma 0. Minus the option, but here we're going to use the bid. But that's one thing you have to do to that formula. Put a negative sign, right? We're selling the call. So here you do, and this is really important because students get really confused on this. Whether you're long or short a call option, the formula is exactly the same. All you do is you flip the bid and the ask. Everybody see that? If you're buying that call option, you use the ask. If you're selling the call option, you use the bid. But the formula is exactly the same. You only have to do one thing when you short the option. The entire formula is the same. The entire thing is a minus sign. So you calculate it and you just change the sign. All right, so there we make money. How do we make money? Well, the stock's trading for 400 bucks. The strike is 500. They're not going to execute that option, right? Well, you kind of hope they do, right? You'd love for them to buy the stock from you for 500 bucks, but they're not going to. So what did you do? You got the $33.65 and you get to keep it. And so that's your max gain. What happens if the stock price goes up at 510? Remember, your strike is 500. At 510, you're losing $10 on the call. Why? Because you sold the callers. But then you got to keep the premium, so your net gain is $23.65. You sold the premium for $33.65, but you lost $10 on the option. And then you start losing money. So what does this look like? So we got to put the two together. Just add them across. What do you notice here? You have a max gain here. Why? Because you sold the call option. That's another hockey stick. A lot of hockey sticks in option pricing. So as the stock price falls, you lose money, but you don't lose as much as you would have. I'm actually going to do this so I can compare it to the stock price. So here, as the stock price goes down, it covers some of your losses and not completely. You get that $33.65. So essentially you got that on the way down, but how much can you lose? You lose a lot of money, right? You can still lose a lot of money. What happens on the upside? Well, at some point you stop making money. Why? Because you sold the call option. At some point, the loss on the call option is going to offset the gain in the stock. Now you look at that and say, is that bullish or bearish? And it just looks ridiculous, right? Do you want that? Does that orange line sound exciting to you? You lose a lot of money on the downside. On the upside, you make a little, but then you stop making money. So why would you ever do this? Let me tell you the one scenario when you do this that makes a lot of sense. Whoops. I always do that. Wrong button. Why would you do this? If I had NVIDIA in my portfolio and my boss says, all right, I looked at the report you did. You know what? I like NVIDIA, but if it hits 500 bucks, we're selling. So that's your target price. So you're sure, yeah, if it hits 500 bucks, we're out of the stock. You say, okay, boss, well, you tell you what, why don't we go ahead and sell it for 500 bucks today? Now, how could you do that? It's not trading for 500 bucks. It's trading for 478. How could you sell NVIDIA for 500 bucks today? You own NVIDIA, you could sell it. If you sell it today, what will you get? 476, but your boss wants to sell it at 500. How would you sell it today? Well, why don't we sell a call option with a strike of 500? What if NVIDIA never makes it to 500? It only makes it to 480. What do we get? The 33.65. That sounds pretty good. What if it hits 500? What do you get? You sell it at 500, you still got the 33.65. So would you rather wait until it hits 500 or sell the call option today at 33.65 at a strike of 500? Which would you be better off at? I'd like to get that $33.60. And if you're absolutely sure you're going to sell it for 500, why not do it right now? If you're wrong, you get $33.65. If you're right and it goes to 500, you're going to sell it at 500 anyway. You'll just let the call option do it for you. That's the only way this loses. The only way you lose on this one is if it closed at 490 and tomorrow opens up at 540. Then you're out of luck. Because if you hadn't done the call option, you would have sold it for 540 because it was well above your 500. This is far better than a limit, kind of a limit sell, you know, or stop gain sell. So, you know, you could put an order in and say, hey, sell the stock at 500 when it hits 500. If it never hits 500, the order is never executed. You could do that on your broker, but this is a much smarter way of doing it because you get $33.65 no matter what. That's your money to keep. And if it goes above 500, you're going to sell it at 500 anyway. So why not get an extra $33.65? So that's the time a covered call makes a lot of sense. Some people do this with puts as well. With a put, you might say, hey, I want to buy the stock I want to buy this stock at 450. Your boss says, hey, if it hits 450, let's buy it. How could you buy the stock at 450 today? Well, you could sell a put option with a strike of 450. What's the worst case there? If it never gets to 450, what do you got? You get to keep $25.50. If it hits 450, what happens? Your put option executes, you get it 450. That's what you wanted anyway. Right? So people like to do that, say, hey, you want to buy this stock at 450? You could put a limit order in and say, hey, if it's 450, buy, or you could just go ahead and execute now. Just sell the put option, the strike of 450. You get $25.50. If it falls to 450, you're going to buy it anyway. You're better off by the $25.50. Okay. Yes, y'all understand how that works? Let's test it. All right, so you're on Apple stock. 190, your boss says, hey, my word, if this stock hits 210, we're out of it. And our models would say 210 is our target price. So what would you recommend to your boss that you could do?
Short call.
Short a call, what strike? It's not a trick question. I would strike it at 210, right? So if you could say 220. You say you're guys definitely saying 210, you could strike it at 2. I mean, you decide what happens at 210, you get a bigger premium, right? At 210 versus 220. But yeah, I mean, just think, you're sitting there in your first job and your boss says, you know what, the target price on this is 210. We're selling it at 210. Say, well, why don't we go and sell it today at 210? Your boss like, what are you talking about? Well, let's just sell a call option today. As a strike of 210, we get to keep the premium. That's a good way to test your boss if they're really set on that 210 and say, well, we might change our mind. Okay, well, you're not that set on the 210, right? Intel, boy, we've really learned about Intel in our portfolio, but our target price is 40 bucks. You know what? If it hits 40 bucks, let's buy it. And what do you tell your boss? Short what? Short of put, strike of 40 bucks. Why? You get to collect the premium today. Now you got to decide on the timing. Is it 3 months out, 6 months out? Where do you get the bigger premium? You go 3 months or 6 months? Go out 6 months, right? So you get bigger premium longer further out you go. These are ways to impress your first boss, right? And give them some options, literally and figuratively, that they can trade on. All right. So a long call, so y'all tell me it's max of what?
That's
So the intrinsic value is max S minus X comma 0. The gain or loss at expiration is that. That's not how you spell expiration, but so we're doing the gain or loss at expiration. So it's the max of S minus X comma 0 minus the premium you paid. I should say call premium. Another way in saying this is expiration. At expiration, the value of the option is the intrinsic value. So it's going to be intrinsic value minus what you pay for the option. The intrinsic value is at max S minus X comma 0. If max S minus X comma 0 is $10 and the option's trading for $12, what's the time value? $2, right? So the intrinsic value is what it's worth at expiration. You can calculate that today, but you still have expiration. You have more time. So if the intrinsic value is 10 bucks, but the option's trading for 12, then the time value is $2. You're getting an extra $2 for it. They give you extra time until it matures. All right, the put, it's the exact same thing, isn't it? Except for what? X minus S. Real simple. Which option price do we use? Bid or ask? Ask, right? This is long calls, long puts, but on the put, what do you use? All right. Protected put. You're long what? Short what? What are you doing protected put? Long the stock
And
and long put, which means your gain or loss at expiration is going to be the gain on stock plus that. What do you use here for the option price? Ask. Anytime you're long the option, you use the ask price. All right. What about covered calls? What are you long and short on here? Long stock, short stock. I call. Sorry. Your gain or loss here. Gain or loss on this, and then here you do exact same thing minus S minus X. Oh, I got an error here, don't I? That needs to be X. Did y'all see that? X minus S. So on the put, it's the max of X minus S minus the put option. So I copied too much from above. So here, covered call, it's this whole thing is in parentheses, but instead of plus, you do minus. And here, what do we use? The bid, right? Because we're selling it. So I don't know. Y'all probably can't see that. It's kind of small. All right. We just keep using those formulas over and over again. If you're short something, it's the exact same formula, just put in parentheses around the entire thing and just use a plus or minus sign depending whether you're long or short. All right. What about collars? What is a collar? So it's easy to remember a collar because all we're going to do with a collar is do everything we did for the protected put and the covered call and just combine it. Put it all together. So collars are long the stock, long the put, and short the call. That's a collar. We did a lot of collars at USAA. It's the reason I ran their stock portfolio for the general portfolio. Small portfolio, but $1 billion. So it's not real small, but that portfolio is up 1% in 08 when the market was down 35%. How do you do that? Collars is not a bad way to do that. So it was a really, really effective strategy in 2008. I'm going to bring the protected put over. We're long the stock, long the put, and short call. Right. So The stock gains can be exactly the same. That's no different than before. We had the stock. The put is exactly the same before as well, isn't it? It's 450 minus 400. So we made 50 bucks there minus the 2570. So we made 2430. Everybody agree with that? Then we got to do a call. So here we're long a put. Here we're short call. So here, I'm just going to set it up before I change the signs. I'm going to do equal max the stock minus the strike from a 0. How much is that going to be worth? The stock's trading for 400 bucks. The strike's 500 bucks. It's a call option. That's worthless. And then which price do we use? Use the bid, right? Because we're short. So there's our short, except we're going to put a minus sign and then put that whole thing in parentheses. So that's actually going to be our gain. And then we start losing money up at the top. So our covered call, so you just add all those together. So you lost 76 bucks on the stock. You made 24 bucks. I mean, you lost. No, you made 24 bucks on the put, and you made 33 bucks on the call. All right. At some point, the put starts hurting you, and then you max on the put is 27 bucks, and then the short call really starts hurting you. Now, I can't think of a sport this thing's going to look like. I don't think there is one, but let me put the stock gain over there so we can look at it next to each other. I don't know, maybe boomerang, I don't know. So there's the cover, the collar. The downside, you're protected. And you're more protected here than we were on the protected put. Why? Because we're getting a gain on the put, plus we're getting that call premium. You can notice we're much closer to the axis here. So we didn't lose as much because we got that wonderful call premium. And then we actually beat the stock for a while. Why? Because we're getting that wonderful call premium, and that's helping us out. But at some point, that call goes into the money and it starts losing us money because we're short that call. So we max out our gain on the top side. We did these at UTSA. You might say, why would you do that? Well, what you're hoping is that the stock market stays between those 2 points. So you get that little extra return. The market crashes, you got protection. The market really shoots up, that's your biggest problem. Now, we did collars at UTSA, and you're probably wondering, we had that protection, so how did we get a gain at UTSA? So what we did at UTSA is in November of 2008, we had this thing rolling over. I went to the CEO of the company and I said, we want to take all the options off. We just want to be in the stock market. My boss was freaking out, and we can't do that. We've already, the market's down so much. And Joe Robles, the CEO, he said, because my argument is the stock market has fallen so much. If we're not buying stocks now, we shouldn't have been in the market anyway. And Joe Robles says, well, yeah, when you buy stocks, you lose money sometimes. So he was like, that's pretty cool, right? Here's this guy, his first year as CEO, the whole world's coming apart. How many of y'all want to be a new CEO of a major firm in 2008? And the whole world's coming apart. And he was like, yeah, when you buy stocks, you're going to lose money sometimes. So we went completely opposite. We jumped off the orange line and we jumped on the blue line, and the stock market went up 10% in December. We went from a 9% loss to a 1% gain on December 31st. On December 30th, we had a small loss. On December 31st. And my boss was like, you better have a positive gain. I was like, you gotta be joking. The market's down 30-something%. But he's like, no, want a positive gain. So we had a positive return. We wouldn't have gotten it if we kept the collar in place, because the market would have shot up and we would have cut off the top. So we had to decide, let's just go completely into the stock market. Then in 2009, what happened
we put this back on. When the market went up 10%, we put this back on. And the market crashed in February, March. And what happened is remember those calls we sold for 30 bucks? They were now trading for like 27 cents. Guess what I did with the calls? I bought them back. It closed that percent. Why would I want to do that? I was worried about the stock market shooting up, and guess what it did? It shot up. And I was so happy we got out of those calls. So was I smart? No, I was incredibly lucky. What do you do in finance when you're incredibly lucky? You retire. You're a genius, and people don't know how lucky you are. But yeah, those two trades were phenomenal trades. Just so fortunate. But that's the collar. Collars are tough in markets we have recently where they shoot up so fast, like they did in 2020 all at once. You don't want a collar in March of 2020 after markets crash 30%. When it shoots back up, you're going to be really disappointed. But collars can be good for good risk protection. As long as the market stays somewhat in that band, you get that little extra return. If it crashes, you got the downside protection. So your only risk is that the market really shoots up. Right, then the last one we'll have to do real quickly. Oops. Now, if y'all remind me on Thursday, I'll tell you my most stressful day in my entire career, which had to do with the 2008 market and these options. It was I aged 27 days in one day, 27 years in one day. So, all right, straddle, R, strangle. On the exam, I'll have to give you a strangle because it's practically impossible for me to give you a straddle if I give you one. So anybody know what a straddle is or strangle? We'll do strangle. Yeah, so you're long, a put, and long a call. So Kyle's brought up something really interesting. There's so many different ways we can combine this. Here we're assuming they both have the same expiration, March. But we could do one that matures in February and one in April. There's all these different combinations we can do. We're not going to do a spread on the exam, but spreads are really interesting as well. We were actually doing, I should mention USA, we weren't doing collars, we were actually doing collars with a put spread. So there's so many different ways. That was why my one day in 2008 was so stressful because we had a put spread. But you're long to put, you're long to call. A straddle is the same thing, but you're at the money. So if NVIDIA is trading for 450 bucks, you have a call with the strike of 450, you have a put with a call of 450. Why are straddles so difficult? Because stocks are rarely exactly at a put price, right? These strike prices are real round numbers, 450 bucks, 425 bucks. You know, if NVIDIA is trading for exactly 400 bucks, then yeah, we can do that. So you're almost always going to have to do a strangle. So let's bring our collar data over here. All right. So at expiration, so the stock gain, which is again, whatever the ending stock price is versus what the starting was. So we're long a put. So again, max of the strike minus stock price and 0 minus bid or ask this time. Ask because we're buying the put. Then we are long call.
So equal max the stock price minus the strike. That's going to be 0 minus bid or ask. Ask, right? Because we're buying same as before. So the straddle. I need to go further down here. We're gonna go down to 350. You'll see why. Huge loss. But the put has a huge gain, right? How do we get that 74.30? Well, our strike was 450. It's trading for 350, so that's $100 minus that option premium. So we made $73. Why do we lose money on the call? Well, we paid $33.95 for the call, and the stock is worth $350. We're not going to pay $500 for stock worth $350. So what is a straddle? You just add those two together. All right, what letter of the alphabet is this going to look like? This is actually a strangle. What? Any guesses? Kind of like a V. Now, a straddle would be exactly a V. A strangle is going to have a little bit of a bowl to it. All right. Huh? Well, without one side, I guess, maybe. So this one has a perfect V, but actually, if I had more prices, there would be a little bit of cup at the bottom because it's not quite in the money. So it gives you that kind of V look to it. Oops. Yeah, I put. Thanks, Bill Gates. Good job. So straddles and strangles have this kind of V look to them. So what are you betting on here? So you can lose a lot of money. Why you lose a lot of money? Because you bought a put, you bought a call, and you're out that entire amount. So what are you hoping for here? Who's your friend here? It starts with a V. So you see a V. Yeah, it looks like you're hoping for volatility. I'm going to show Riley's class today and Elizabeth why annuities and a life insurance company look like a short straddle. What would a short straddle look like? Be upside down. What are they hoping for? Stability. All right. But when you do this, it is volatility. So if you remember that book I showed y'all on Amazon, this book right here, this whole book is about straddles. Why? Because he's talking about doing straddles right before a firm announces earnings. What do you expect when you announce earnings? You expect a lot of volatility. That's when you want to do a straddle. I wanted to show you a straddle. I might take like NVIDIA stock. A few days ago when it was up so much, like 30% in one day, would a straddle have worked well? Probably. We'll have to see how expensive the put and call option was, but that's what this whole book's about. You don't just do it. You don't just go out and do straddles every time there's an earnings announcement. Essentially what you're doing is you look historically at how volatile the stock prices were in earnings announcements, and you're looking at what the implied volatility is today, and you're trying to find those stocks where the volatility in the option pricing isn't high enough for what you might expect. So it's pretty specialized trading strategy. A friend of mine did this. He started a hedge fund doing this, and he was making like 8 to 10 basis points every day with very little downside risk. If you add that up, 10 basis points a day for 250 days, that's a really, really good return. So he was making a lot of money in doing it in a very, very safe way. This was the strategy he was doing. So what he did, he wrote a Python program. He was bringing all these stocks with earnings announcements. He was looking at the implied volatility and the option pricing, looking at historical volatility around earnings announcements. He had all that set up in his massive formula. And his spreadsheet would tell him, here's some stocks that look like you could have a really good trade by doing a straddle. And he was having great, great success doing that. Right, so there's a straddle, your long, you put, and long call. So all you have to do, very simple, isn't it? You're just combining those first two together. Everything's the same, you just add those first two together. So what other strategies are there? Oh my word. There's some that I've never heard of that are out there. These are practical ones, I guess. No pictures. I like these, but I'm not getting. All right, without looking at it, what is that? If I gave you that picture, what would it be? It's either a long call or what else can it be? Protected put, right? There's a long put. There's a call back spread. So when you see the word spread, what does spread mean? So we did put spreads at USAA. A put spread is you buy a put with a strike of like 500 and you sell another put with a strike of like 450. So between 450 and 500, you're protected. Below 450, you start losing money again. Call spread, you do the same thing. You buy a call with a strike of 500 and you sell another one with a spread of a strike of 550. It cuts the cost of that call down because you don't really think it's possible it's going to go above 550, but you think it might go above 500. You get to cut the cost of that by selling that. So that's a spread. There's a call spread, a put spread, protected put, right? These two look almost identical. Bear split, strike combo, that one I'm not real familiar with. But what else are there? There's butterflies and all kinds. I mean, there's just, I think I have a link in the class notes that does that. Cover call, we've already done that one. There's the covered call. That looks familiar, right? We did that. Married put, I don't know what that means, but a married put, I don't know what it's married to, but put call spread, bull call spread. So spreads are just, you're buying and selling something, usually doesn't have to be the same expiration. Usually if you're going to go long and short on something because of time value, you want the expiration on the short to be shorter than the expiration on the long. Why? Because time value really declines the last month. And when you short something, you want time value to decline, right? Because you want the thing that you sold to come down in price. But if you're long an option, you want that time value. So you want to be able to roll it over with more time value. So at USAA, when we did spreads, whatever we shorted would maybe be 1 month, and whatever we went long on was 3 months. So we try to maximize that time value as much as we could. There's another spread, protected collar. That's just a collar, right? They call it a protected collar. That's a collar. Y'all remember the collar? A long straddle. We just did that, right? There's your long straddle. Looks like a V. Long strangle. So I couldn't get this because I didn't give enough iterations on the price, but ours would look something like that on the strangle if I'd had enough prices in there. You'll see the difference between a straddle and a strangle. Let's just get a little bit of a bowl shape to it. Butterflies kind of look like butterflies. These are pretty interesting strategies. I know a lot of people love the butterfly. So this is like a short strangle, but with protection on the end. How do you do that? Pretty simple. You just do a short strangle and then you do some spreads on the end. So protect that downside. That's a pretty interesting strategy, right? You're gonna make a lot of money or you cap your losses. That sounds pretty interesting. An iron condor. Iron condors are pretty popular. butterflies. So how many more strategies are there? Bloomberg has a really good function where you can do 10 legs. You can do longest call, sort of put, you can put spreads in there, you can do 10 legs, including the underlying stock. You can just go wild, and then they let you do scenarios. What if the stock price goes to this? Oh, yeah, you can do all kinds of things. I've never done three legs plus this underlying is the most I've ever done, but you can get pretty crazy on these things. Some of these are pretty interesting. What most people do is they have some idea about volatility in the stock market direction, and they'll pick the strategy that fits that scenario that they have. And part of this also is going to be what are option prices doing. Right now, you know, the VIX is pretty key to all of this thing. So the VIX, wow, the VIX is ridiculously low right now at 1269. What that means is if you're buying options, they're really cheap right now. You're selling option, you're not getting much. So now's the time to do one of those long strategies. Because the VIX is very low, but it wasn't that low too long ago. It had gotten pretty high there above 20 not too long ago. That'd be a good time to be selling. So that's the debate we had at UTSA when in November. One of the guys was saying, well, we're doing that spread, so you're selling options, you're getting a lot of money for those. But I said, we're getting a lot of money on them because the market doesn't know if it's going to rise 20% or fall 20%. So I just want to get out of the options entirely. So we had that debate. But right now is a good time to be buying options. So anytime the VIX falls below 10, I'm almost always buying options because they're so ridiculously cheap. 12 is a pretty good place to be buying options. So it's a pretty inexpensive place. How much does it matter? Well, you can go on the CBOE and set up an option and change the volatility and see how much the price changes. It's pretty material. It has a huge impact on option prices. All right, so y'all see what we're going to do. The only thing we didn't cover was time values. So you see if any team can handle that. Maybe I'll give an extra bonus so I can really pressure team 3 here. If anyone gets the time value correct. But we'll do time value on Thursday. All right. Questions or anything? Our last team question. We'll announce the winner. All right, so let's look at this. Before we do, this is a really simple question, but students grossly complicated. So you got to know what intrinsic value is. It's a really simple formula. For a call, it's just max of stock minus strike and 0. For a put, the max of strike minus stock and 0. Real simple. What's time value? Time value is option premium minus intrinsic value. Well, that's real simple. So we use this formula again. And then what's the gain or loss on an option? It's going to be in, this is at expiration, which is what we're doing. Real simple. It's just intrinsic value minus the option premium. That's all you need. That's all you need for this problem. It's really simple. Now, in your strategy, you got to know, are you long the option, short the option? There's none where we're short the stock, so you don't have to worry about that. You just have to figure out if you have the stock or not. So for the put and call, there is no stock. Protected put, you own the stock. Covered call, you own the stock. Collar, you own the stock. So the only one where you don't own the stock is the straddle, right? So that's pretty straightforward. The covered call and the collar, you short the call, but there's none where you short the put, so you don't have to worry about that. So if you are long, you use the ask. If short, you use the bid. That's 100% of what you need to know, except for the definitions of protected put, covered call, collar, and straddle. I've only given you 4 strategies. How many strategies are there? Who knows? At least dozens. So it's a really simple question, isn't it? It's not that complicated. So in this first one, you buy a call option with a strike of 248, expiring October 23rd. Calculate your gain. Well, the intrinsic value gonna equal the max of the stock price. What's the stock price? 248. Boy, that's strange. I don't know why I did that. Wow, that's really strange. Yeah, there's like a typo in here. Did y'all notice the typo? That should probably be 240. Sorry. We'll see how y'all handle that. Sorry. If y'all see it on exam, come ask me because there's no way. Y'all, I don't know why none of y'all came and asked me. So, I can say I intentionally did that. How could you even do that if I didn't give you the data for it? Did y'all just assume it was 240? All right. So the max of 240 minus, so the stock's trading for 248. Max of the stock minus the strike and 0. So the intrinsic value on this one is what? It's $8, right?
Yeah.
And so the gain is going to be 8 minus what's your option premium? 1435, right? Equals minus 6. He lost $6.35. So sorry about the typo. All right, on this one, hopefully no typo on this one. You buy a put option, the strike is 230. That looks good. So the intrinsic value equal to max of the strike is 230 minus the stock is trading at 202 and 0. So the intrinsic value is what, 28? So the gain will equal 28 minus 2020. It should equal 780. That sound right? The next one's a covered call. So the stock gain or loss, because we're long the stock. So the stock's initial price was 225. It's now trading at 248. So 248 minus 225, that equals 23. 225, 248. The put option, the intrinsic value equal the max of the strike of 240. Oh wait, there's no put option here, sorry. The call option, the intrinsic value can equal the max of, it's trading at 248 minus 240 and 0. That's going to equal 8. The gain is going to equal 8 minus, now what do you use here? Which one? Yell it out. The bid, 1380, right? Because you're going to be short that. So minus 1380, that equals a loss of 580, if I did that right. And so the covered call is going to equal 23 minus 580. So that should equal 2880. Right? Because you're short the call. So whatever you get on the call, then you do the opposite of that. So the call would have lost 580. It had a gain of $8, but you got $13.80. So you lost $8, but you made $13.80 when you sold it. So you end up with a net gain of 580. So you end up, anybody see any errors in that? Because I'm doing this top of my head. Hopefully it's correct. And then time value, again, time value on the put, pretty obvious. The put's 2020. The intrinsic value, we've already calculated, but intrinsic value equals the max of 230 minus, it was trading at 225. 0, that equals 5. 220 minus 5 equals 1520. All right, so you see how you just keep using, you see how often you do the intrinsic value? If you don't understand the intrinsic value formula, you're sunk on this problem. S minus X or X minus X.
X minus S. If you know that formula, you got 90% of what you need.
So it is a pretty simple formula. Everybody should get 100% on A, B, and D. And then you just have to figure out, if you remember, what are your long or short and what you're long and short on. You're not short on the stock ever. You're not short on the put ever. So it really comes down to the call. Am I long on the call or short on the call? All right, questions on that? So with my one typo, I made it kind of tough, but all right. Now, do we need to talk about time value anymore? Time value is pretty, you know, the intrinsic value. Time value is what? Someone tell me. Let's see if anyone's paying attention. Time value is your premium. Premium minus intrinsic value. Intrinsic value, what's the time value at expiration? 0. So you at expiration, the option will trade at the intrinsic value. All right. Now it gets a little tricky. I didn't realize this until my first option trade. But options expire on Saturday, not because you can trade on Saturday, expire on Saturday because they're priced off the open on Friday. That's really important. Not the close on Friday, but the open on Friday. That gives you the entire day on Friday to close your position. Because if you don't do that, you've got a big mess on your hands. So that's why they expire officially on Saturday. What I didn't realize was the open's not the open. So I had an option, I was short, a call option. And I look at the open and we were still out of the money. I was like, great, I didn't lose any money on this one. And my broker calls me and says, you know, you owe $300,000. I said, no, the open price was less. He said, no, that's the open that you see on Yahoo Finance. That's not the official open. The official open, and I said, there's an official open. That doesn't make sense. So the open you see that's reported in Yahoo Finance is not the actual open that they use for option pricing. So it gets a little tricky, but think how nerve-wracking that is. And I learned this very quickly. There are times I was going to let the option expire on Friday because I could see where we are at the end of the day. But sometimes where it closes on Thursday, when it opens on Friday, it can be radically different numbers. So I learned to close the thing out on Thursday, so I don't have that stress all night, you know, that some big news is going to come out. So there's things you got to learn with these options that can be really, really shocking. All right, no questions on that. Now, have we learned options? Don't go out and tell people we study option pricing, because we didn't. Option pricing is how do you figure out the value of that option before expiration? All we talked about was at expiration. Before expiration, you got to add all that time value in there. That's Black-Scholes, that's binomial. If you take the speculative markets class here, which I highly recommend, they spend a lot of time on binomial and Black-Scholes models. You'll probably never use it in your life because they're always built in computers. So I used to have the Black-Scholes memorized, but I don't have it memorized anymore because it's just too many letters. It's not that difficult of a formula, but you just put it in an Excel spreadsheet and it does all the work for you. But it is good to learn those formulas and see how they work because they're quite powerful things. Now we talked about a straddle, so I went out and ran the straddle for NVIDIA. So NVIDIA stock on May 25th jumped 79 bucks in one day. That's a pretty hefty jump in one day, like 20-something%. So if you've done a straddle, I remember what a straddle is. You buy the call and you buy, this is actually a strangle. You buy the call, you buy the put. So at the time I did the straddle, it was trading right at 300 bucks. A call at 350 was 269. A put at 250 was 199. So what it cost you $4.68. That's if you did one option. If you did a million options, it'd be $4 million or $4.7 million. So what happens to the put option when the stock price jumps? It went from $1.60 to 18 cents. You lost a lot of money on that put option. Are you in tears or not? You don't care. That's why. What did the call option do when the stock price jumped? It went up 100%. So how did your strangle do? You made 700%. So if you put 4.7 million into this, you would have 37 million at the end. How many of y'all have gone from 4.7 million to $37 million in 1 week? When's the last time you did that? It's probably been a few weeks, right? It doesn't happen every week. So it worked. But that was a pretty extreme case. I have seen some where the stock price moves a bunch and the straddle still loses money. So I did one other one because I was just curious. I did Blackstone just because we have one of our students is working at Blackstone. So I was curious. Their stock jumped from 107 to 104. So it's about a 4% jump in one day. The straddle would have cost you $2.63. It matured at 403. So on that one, that 4% was enough to make you 53% on the straddle. Now, if you don't make 53%, what are you likely to make? You could lose 80, 90%. If it doesn't move much, you could lose 100%. But these are very popular strategies because you can make a whole lot of money, but they are expensive. So you got to be careful. So how did I do this? Well, in Excel, in Bloomberg, this is how you do an option in Bloomberg. That's the ticker for an option. The ticker for the stock, BX. So if you're doing the stock, it's BX US equity. That's how you get a stock. So how do you do options? It used to be really complicated. It used to be options had this massive number of letters. I don't know if y'all know CUSIPs for bonds. So it's a bunch of random letters all together. So for options, it used to be like that. They fixed the option. So you can see now it's actually pretty easy to figure out for the option. It's BXUS. The 12/23 is the expiration, and they fixed that as well because remember, or you realize, there's multiple expirations. So is it December 15th? Is it the 20th? You can just put the month and the year in there, so that's kind of nice. You can't put the date. If you know the exact date, you can put 3 days there. C110, what is that? C means it's a call. 110, what do you think that is? The strike price. So you got the expiration strike price, and then equity because you're doing an option on the stock itself and not on the index. So much easier. I used to have all those letters, and it was just a pain. So that's pretty good. So you actually can go on the Bloomberg and get historical option prices using this ticker. You can see I just brought in PX last, which means bringing the last price. Now, what should I be more accurate? What should I have done instead of last price? When I bought them, I should have used what? Should have used the ask price. And when I sold it, what should I have done? Use the bid price. Could I have done that? Yeah, you can. You can tell Bloomberg, bring in the bid and ask. The problem is when you do that, sometimes you'll get NAs every once in a while. So you have to be a little bit careful. But one thing I learned at UTSA, they were using last price on my mutual fund. Well, last price on option could be like at 1 p.m. and the stock could have moved a bunch. The bid is at the end of the day. So I remember I looked at my mutual fund and I go, there's no way that's correct. So I called the accountants and said, there's no way that's correct. And they were using last price. I said, well, the last price is 5, but the last bid is 7. 7's the right number because the last price, and the last price could be 6 months ago. Who knows? Options don't trade every single day. So they had to switch their process. Instead of using last price, they actually use the last bid, or they might get the bid and ask and use the midpoint, something like that. So options are a little tricky. It's not like stocks where you can be real comfortable with the price. So if you're doing your own, and this is what we did with the student portfolio with our investment society, we used the bid and ask to price our portfolio. We didn't use the last price. I used the last price here just to keep it simple, but I could have gotten much more accurate. So I overstated my return a little bit because I was using last price instead of bid and ask, but you can get much more precise. But Bloomberg has all of that. So if you want to go back and do some interesting analysis on options and how strategies work historically, you can do that. You got to be careful though. What do you think this is going to do January 2024? And it disappeared. There's no price. That doesn't work with Apple, right? And Apple, they'll still have a price if they're still in business. But with options, you can't go beyond the expiration because there's no price. So you got to set it up very carefully. But Bloomberg can handle it, and you can bring in all kinds of data historically. It's pretty amazing. All right, so there's a good straddle. I don't know if we talked about this, but if the If the stock price is higher than the strike price, that's called in the money for a call. If the current price is greater than the strike price for put, that's out of the money. So for calls, if the intrinsic value is positive, that means that it's in the money. If the intrinsic value is 0, it's out of the money or at the money. Okay, so that's good to know. I don't ask that on exam. So here's all the combinations we're going to have. We talked about put call parity. I strongly recommend you read on that. It's a really interesting part of finance. We didn't talk about spreads. Spreads can be price or dates, or you can, it's just you're mismatching something. So you might buy a call with a strike of 110 and sell a call with a strike of 130. There's so many different combinations you can do. You can really go quite wild on these different maturities. Now we know with more time you have more value, but in 2008, the most bizarre thing happened. The near-term options were more expensive than the long-term options. I wanted to quit my job and just put millions of dollars. You could have set up a trade, but I didn't look at was the bid ask, so I probably wouldn't gotten killed on the bid ask. But that's the first time in my entire history, and I don't think it's probably ever happened ever since, where near term were worth more than long term because of what was going on in the markets at the end of that year. So you get some bizarre periods of time there. The Greeks, we've already got the Texas videos. The Greeks, delta, what you're saying with the delta is how does the option price move relative to the underlying? So if Apple's up 10%, how much is the call option up? If it's up 10%, your delta is just 1. But if it's up 40%, it's up more. So delta is telling you how much volatility there is in that option. Gamma is telling you how the delta changes when the prices change. That sounds like what? Delta and gamma sounds like what when we talk about bonds? You remember anything on bonds? DC cuts I. What does delta and gamma sound like in DC cuts I? Duration and convexity, right? Delta and gamma are like duration and convexity for bonds. So gamma is how does that delta, and that's really, really important. You're looking at that collar. Remember on the collar, no, the covered call, remember at some point you're going to hit that strike and you're not going to make any more money. So your delta may be good for a while, but once you hit that, your delta is going to 0. Because once you hit that max, it doesn't matter what the stock price is, you're not making any money. So you got to watch that gamma really carefully. At USAA, we did collars, and with collars, yeah, you would watch that gamma, and it would get to 0 at some point. And so you have to be real careful on the gamma. So be careful that you're not focusing on delta and forgetting about gamma. Theta is real simple. How does the option price change with one more day going forward in time? It's just that time decay. That's going to increase as you get closer to expiration. Vega is how it starts with the V, so it makes it easy. Vega is how does the option price change given the underlying volatility changing? That's pretty straightforward. And rho is interest rates. I don't know if you care too much about that one. That one's not going to have as big of an impact. So how do you use options? This is how I use options. So this is USA's 2008 annual report. There's my boss's boss. My boss's boss. Yeah, 2 people ahead of me. That's the CEO. Anybody know Joe Robles? He was my favorite CEO. I had McDermott, who I was scared to death of. I only saw him twice. Davis, that I was scared to death of, but I saw him all the time. And then Joe was my favorite. The smartest guy, nicest guy, just wonderful, wonderful man. So he and I worked a lot of projects together. And so he, in his annual report, he put my portfolio in his annual report. Why? Because we were up 1% when the market was down 37%. So I was kind of nervous about him doing that because my mutual funds didn't do that well. I was worried members were going to call in and say, well, why did your portfolio do so well when ours were down 20%? But so he even brought that in here. I forget where he wrote about it. Our conservative investment portfolio enables us to cushion ourselves. We cut, let's see, he said, is it somewhere in here? But anyway. Ourselves from even greater losses, but actually had a gain. So how do you get 1% when the market's down 37%? You got to do options. So I'm a huge believer in options. I think they're a tremendous tool. but you better know what you're doing. They're pretty dangerous. My option trader, a really smart guy. He's from San Antonio. I wish I could get him back. I wish I could get him back down here. He was at Credit Suisse. This incredible smart guy. He's moved on to some startup company. I talked to him once, a couple years ago. I need to contact him. If he's in San Antonio, I want him talking to my students. That's a really sharp guy. He sent me a spreadsheet with all my Greeks so I could look at my gammas and deltas and all that kind of stuff. But I would call him with a strategy, and he within like 30 seconds would let me know I was an idiot. I didn't know what I was talking about, that I had switched something in my mind. But I love talking to him, just really good. And he left Credit Suisse, and his replacement was not nearly as confident. And so I'll tell you, my worst day at USA was we had a put spread. So we're long a put and short a put. That's going to do great when the market falls, unless it falls along my short put. And so I had a short put. It was out of the money. It was going to expire worthless. I was wanting to expire worthless. Only had a few days left. And then the market started getting uncertain. So I call Stu's replacement and I say, you know, the market's looking unusual. I think I want to buy that put back. Why would I buy it back? Because the market crashes, I don't want that exposure, right? But while I'm talking to him, the market recovers. I said, never mind. Hang up. The market starts getting wild again. I call him again. Say, man, the market's getting wild again. I think I want to buy that put back. And while I'm talking to him, the market settles down. So I say, forget it. Third time I call him. Man, the market's starting to look wild. He's like, he's the newbie, right? He's like, I'm freaking this poor guy out. And I forget his name. I'm sure he hasn't forgotten my name, but that was a horrible day for him. But I go, you know, do it. Buy it back. I hang up, and it seemed like 3 seconds later, I'm sure it must have been minutes. The market craters. It's like down 10%, like minutes. And so I'm thinking, there's no way he got that trade. My heart rate's like what's the max heart rate you can have and not have a heart attack? Whatever that is, I was 2 points above that. So he calls me back, and his tone is like, Ron, I'm thinking he's about to tell me he didn't get the trade in. But he goes, Ron, boy, I got that trade in like just in time. And he got it in just in time. I'm talking within seconds, hundreds of millions of dollars. I mean, it was massive. So very lucky. We would not have been up 1% if I hadn't got that trade in. It was pure luck. I remember so clearly after I hung up, I literally laid on the floor in my office until my heart rate got back to normal. It was extremely stressful. You got to make decisions like that in markets like 2008. It's just not fun to be in finance, but you got to make decisions. So, all right. So any questions? Let's talk the exam. So everybody should make 100 on the exam. So you've got 2 practice exams. Everybody knows those 2 practice exams. Y'all seen them? So looks exactly like our exam. We're going to do the exact entire exam in class. There's not really many essays, although question 1 is a little bit of an essay. You got to do the revenue, operating leverage, financial leverage. But that's the only one that has any discussion. Mainly it's just math, and it's really simple math. So if you don't make 100 on it, then there's some issue with how you're addressing finance. So anybody uncertain about where the practice exams are, they're their own canvas on their exam reviews. You know exactly what's on the exam. It's not going to throw you in an 8th question that you're not aware of. There's no extra credit questions I'm going to throw in. So who in here is not going to make 100 on this exam? You all promised me you're making 100. You got that guaranteed. All right. There's nothing. What on this exam should you not know 6 months from now? You should know every finance major knows everything on this exam. All right. There should not be a single thing on this exam you forget. So what questions do you have on the exam? So there's the exam 2 guide. I give you Harmel and Best Buy. You might have a third exam review because I don't know what that one is. So who knows? Have y'all looked at this one? that a different one? Beside Hormel, and let's see, what is it? I don't remember. Ah,
So what is ClickUp? ClickUp is an all-in-one productivity software where you can manage everything and
I'm getting $0 for these advertisements. All right, so that's Hormel, so that's the same one as the exam review. So Hormel, you got that, walk through that. So make sure you have the revenue sensitivity and all. If we were doing an exam in class, you would actually do the rolling data in class in Excel, but since we can't do Excel in class, you have to just, I have to give that to you. So, but it's all in the videos. So it's price of corporate bond. You should have learned that in 2013. So I'm just refreshing your memory on that. That's very straightforward. Stock valuation, you should have done that in 2013. So I'm just refreshing your memory on that. Calculating returns, that's probably unique. You didn't do that before, but real straightforward stuff. Holding period return and then arithmetic and geometrically linked. You'll do that a million times in your career. Just make sure you know it now because it's extremely important stuff. The relative value, where people mess up the most on. So you have to have two things there. Which ratios are just wrong and why, and then which one's most appropriate for your industries. So you have to remember, if you're doing Apple, what ratio would you probably use? Technology stock,
That would be good.
huh?
Agree.
Which ratio? So EV to EBITDA is what we usually use tech stocks. If I was doing Chipotle, what would I probably use? Retail, consumer stock, EV to revenue. If I were doing Boeing, industrial company, a lot of property, plant, and equipment.
You need to put back.
Close. Why wouldn't I use the EV, the book value?
Because of the-
But that's good. I'm glad you brought that up. So why wouldn't you use EV, the book value? EV belongs to stock and bond holders, book values on the stockholders, but price to book. Yeah, price to book would work. I won't give you a bank, but if you did a bank, that'd be price to book. If I gave you an energy company, price to book. So high property, plant, and equipment. Those that are really volatile, like steel companies that are related to some commodity, and insurance companies and banks all use price to book. So that's the one students need to work on. And then we just did the option transaction, very, very straightforward. And that video, for some reason, is my most popular YouTube video. I just got someone this week that said I saved their life, which seems a little exaggerated to me. This doesn't really even talk about options. It's just the basics of how to calculate the gain at expiration. So I don't know why they found it so anything in here you're having questions on, you know, 5 is usually the one, but the other ones should be straightforward. I'm amazed people don't get full credit on 2 and 3. Now, one thing I noticed on 2 is there are a few students, and this is amazing when you're finding students, a few students, they see 5% and they type it as 5. 5 is not 5%, 5 is 500%. So, you know, still, you know, hopefully you got that in 2013. I get that in some graduate students, but y'all shouldn't have any problems with that. If you get a discount rate for a bond of 23%, you probably did something wrong. If you get a discount rate of a bond for 1%, you probably did something wrong. Bond discount rates are usually 5 to 10%. You get a discount rate for a stock of 2%, that's wrong. If you get 43%, that's wrong. It's going to be somewhere in that probably 6 to 15% range. So you got to know what's normal, so you know you have a math error. So if someone types 5% as 0.5 instead of 0.05, and they get a 56% discount rate, they should know that can't possibly be right. You get a net negative value on the stock valuation. How many stocks do you know that have a negative value? Not a whole lot, are there? What's the minimum value on a stock? 0. So if you get a negative number, what do you know? You did something wrong. Go back and fix it, all right? So there's some obvious things that exam anxieties shouldn't mess up. You should take a breath and say, wait a minute, that doesn't seem right. So, all right. Any comments, questions?
The exam's at 12, right?
Whatever the exam review says. I'm going off, I've checked it twice and I don't think it's changed. So December next Thursday at 1 o'clock. It's a 75-minute exam. We have almost 3 hours to do it. So you should have plenty of time. You can stay the full time. I don't know if there's another class coming afterwards, so you have to stop, but you have plenty of time. It's closed notes. You just need a calculator and I'll give you blank. All you need is a calculator and something to write with. You don't need anything else. So, should have plenty of time. Don't be late. Get here on time. Be ready to go. Any other questions on the exam? So I'm calling you at 2 a.m. if you don't get 100. So everybody in the class should. There's no reason not to. Right. So just some closing thoughts. So, Munger, y'all know Munger. He passed away this year. They're hoping to make it to his 100th birthday party in January. He didn't quite make it. Kissinger passed away. Kissinger just wrote a book. I don't know if I'll be writing a book at 103 years old, but he just wrote a book. I don't know how much of the writing he did, but he just passed away. But Munger, not as wealthy as what's his name? Buffett, yeah, excuse me. It's not as wealthy, but a couple $1 billion, you can probably get by on that. Just like Buffett, he lives in the same house he bought, really conservative. But what I like what he says about learning, because I fear there's a good number of students don't believe this. So your finance majors are actual science majors. So you're gonna be doing this the next 50 years of your life. I get the impression there's some finance students that are already bored to tears with finance. And that's just real. You saw what I went through in 08. You better enjoy finance because 08 is going to be a tough year, even if you love it. If you don't love it, it's going to be a horrible year. But I love what he says. I heard someone else say it even better. Y'all know compounding of interest, right? What happens to compounding interest over 20 years? It's massive. Well, I don't think Munger said this, but someone said it real similar to what Munger's saying here. He talks about compounding of knowledge. Compounding knowledge over time becomes massive. And so he's saying here, see people who rise, who aren't the smartest, are the most diligent. I do think you have to be the most diligent. But they are learning machines. They go to bed every night a little wiser than when they got up, and boy, does that help. So he says you cannot waste a class. You can't waste the day. Every single day you should be learning. The way I did it at UTSA, which I highly recommend, I was scared to death when I started work because I thought, well, there's no way I'm going to succeed. So I was scared to death. That fear got me just like every chance I had to learn, I was learning. Someone came to my desk with a number that I didn't know how it was produced. I would lie to them and say, I got to be explaining this to my boss. Can you explain it to me? And I would go back to their desk. I would sit there for 3 or 4 hours. A lot of times it was actuaries, which they were smarter than I was by several miles. But I said, I'm sitting here until I understand. And they would explain it and explain it and explain it. And I did that every single opportunity I had. Any number I got that I did not understand, I used that as an excuse to go talk to somebody. And guess what? I never had anyone say, get away from me, kids, you bother me. Every single time they would spend the time to explain it to you. And a lot of them wanted to. A lot of them, especially actuaries, they're the smartest people in the company. The whole company goes insolvent if they mess up, but no one has a clue what they're doing. So the actuaries are over there the whole way the company's on their shoulders and no one appreciates it. And here comes this young green kid like, wow, you guys are so smart. I want to know everything. They're like, they love it. They love teaching me. It was like the greatest thing in the world. The other thing I wish I'd done more of, but you should probably do this, is, you have to do it right socially, but just let people know, I want to know what you do in your job. I want to take you to break. Can we go to break today? Can we go to lunch today? Just people you don't even know what they're doing. So, there's people at your desk all the time. Your job must be incredibly important. I have no clue what you're doing. I take you to break sometime and people love that kind of stuff. You got to work it out with their schedule. Don't make it sound like you're asking them out on a date. So you got to do it as professionally. If you're worried about that, then take a friend with you and go ask them. You got to work it out well. But
you got to take those advantages. And I see students in class that don't even do it in class. You're stuck here 25 classes. You should every class be, man, what did he say in class today? And then go look it up and go Google that. What is, every single class you should never waste a class, never waste an opportunity to learn something new. So, so in the long run, that's going to be a big difference. So you're starting now building that knowledge base, and you're going to build on that knowledge base. So the earlier you start, the more massive it is. So your goal is to get to what I call, I can't think of the word I usually use, but it's kind of a visual intelligence. So when you start, you don't have it. And after 4 or 5 or 6 years, you suddenly have it. So visual intelligence, for me, it's balance sheet immunization. That's my thing. I know that better than anything else. As I tell people, I know a whole lot about very little. That's really what finance is. You just specialize. But when a balance sheet immunization problem comes up, they give me information. I can see the whole problem in a nanosecond. I can see the whole outlay. I got to know this number, I got to know this number. That's what you're trying to get to in your intelligence. Is a problem comes to you, like if you're doing options, like that guy Stu at Credit Suisse. He knew all the Greeks. He knew everything. When I brought a problem to him, he didn't have to sit down. Let me work this out. He could, in a nanosecond, he saw the entire problem. He could come back to me. That's where you're trying to get in your intelligence. How do you get there? You got to start capturing it right now as fast as you can. So you're like desperate to learn. How many of y'all are just desperate to learn? You leave a class and you're like, I got to learn more about it. I got to read more about that. That's where you got to be. If you're not doing that, you're probably in the wrong major. So you got to get to that point where you're just desperate. So I had the advantage that I was scared to death. Fear is a good motivator. I was like, I'm going to be an idiot. They're going to fire me in 3 weeks. I better learn this stuff. So that helped me tremendously. That's not bad. You're starting out. Some of you are pretty cocky, so you just got to kind of admit the fact that you don't know as much as you think you know, and just still kind of create your own fear in that. But just learn. So I think that our life properly lived is just learn all the time, every chance you get to learn. If you're on the corporate side, your goal is to learn the most complicated thing in the business. At Valero, that's probably the trade desk. It's probably how the refiners. So if you're at Valero, beg them, and I know, Kevin, they would let you do this. Beg them, hey, I'll pay for the trip myself. I want to go to one of your refineries and spend 3 days there. Kevin, would they let you all do that, you think? Maybe not.
They took me twice.
Took you twice? Did you learn a lot there, or was it kind of too high level?
No, the second time I went, it was just me and my manager, my partner, and so it was a little more personal. So we got to actually go see the ship, get on the ship, get into the refinery more. Then
Yeah.
the first time with a big group. So.
When Dr. Miser was here, his big complaint was about finance majors is like, they think businesses are these magical things. Customers show up, buy stuff, employees always show up on time, inventory's right there on time. Everything's this magical thing. And he says finance students need to realize how complicated running a business is. There's at HEB every single day, there's a major emergency somewhere. There's someone that didn't show up, there's some customer that's irate, something horrible, right? Don't you agree? Somewhere at HEB right now, something massive happened. A whole aisle fell over and there's just flour everywhere, whatever. Businesses are complicated. Customers don't just show up. They show up because you have something to offer. What do you have to offer? So Valero is really complicated business, right? They're buying oil, they're refining it. Well, that presentation did a few weeks ago was really interesting, really complex. They got all these different kind of supply and demand. They got to match. What are they going to produce? How much are they going to produce of this versus this versus this? What are they going to shut down? You got to learn that at HEB. The most complicated thing at HEB is the supply chain, the farmers, the products. It's Kellogg's, it's Coca-Cola. It's understanding that. So if you work at HEB, you got to go through the supply side. We have one of our former students that's on the supply side, and she understands that business. At USAA, what is it? I just kind of told you. The actuaries at USAA. I figured that out really fast at USAA. Go talk to actuaries every chance I got, and that helped my career. USAA also had a department of nothing but PhDs in math. I was in that department almost every day. It was like every chance I got. They were the nerdiest people. No one ever talked to them. So when I showed up, it's like, wow, we have a friend today, and they just loved it. And I just learned everything I possibly could. One of the guys was doing a elasticity study of USA's auto insurance. I thought, wow, that's really fascinating. How would you do that? How do you do the math? How do you get the data? It's fascinating stuff. One of the guys there, I was telling him our stochastic model messed up my correlation table every single time, making it positive definite. Says, oh, I wrote a program that fixes that. Oh, you gotta be kidding. So he sent me his program, fixed my correlation table, went out like 40 decimals, but if my correlation was 0.89, my model changed the 0.89 to like 0.6. It's like, I don't want that. His changed it from 0.89 to 0.88326, out 20 decimals. So that's really cool. Do y'all know what a definite positive correlation table is? Well, how do you figure that out? You go ask the question. So you got to be learning. They say, find what you love and do that, and you'll never work a day in your life. I don't believe in that. Because what you love doesn't pay any money. So they don't pay you money for sitting on a beach. What you do is you find what you're interested in, and then you learn it at the lowest possible level you can. And then the joy is that you're the expert in the room. That's what you're trying to get to. You're trying to get there as fast as you possibly can. So students ask me about a graduate school. I'm not a huge fan of graduate school. Give it 6 or 7 years. What is your goal in finance? It's to find that thing you're a specialist in and find it as fast as you can. If your first job, you're training your boss, you better run for the hills. Your first job, you better be scared to death of your boss. He or she should just scare the life out of you. Now, mine didn't, because I was in accounting when I started. But when I moved to finance, my first boss, especially my first boss's boss, I was scared to death of that guy. I wasn't scared because he's just mean. I was scared of him because he knew so much. He had a PhD in economics. He wrote textbooks. I was scared to death of him. He was a pretty rough guy. I loved the last time I had lunch with him. It was after I hadn't seen him for years. I was telling him what we did at UTSA in the pension plan. And he goes, Ron, you're over my head. I don't know what you're talking about. I was like, wow, that's pretty cool, right? This guy I was so scared of. Not because he wasn't smarter than I am, but because I was specializing in an area he didn't have a background in. It's just, and you want to get to that as fast as you can. I want to see some of y'all in 4 years and having lunch with me, and I have no clue what you're talking about. They're so over my head, and that's what you're aiming for. So anyway, I probably should have told you that the first day of class, but if you're not getting something out of every single class, I would be taking notes by hand, not on the computer. My retention from my undergraduate and graduate studies is amazing. What I still remember from those classes, because I took notes by hand and I recopied them by hand. I would probably today take notes by hand and redo them by typing. But studies have shown writing notes is the best. Retention is your goal, isn't it? Comprehension and retention. What about comprehension without retention? What is that? That's a waste of time. So if I were to ask you right now, write everything you learned in this class this semester, you should be able to go 40, 50 pages off the top of your head without looking anything up. That's where you should be right now. It's retention. If you can do one paragraph and no more, you just wasted 3 months of your life. And who in here wants to waste 3 months of your life? Because you got to pay your bills the next 50 years, don't you? You want that house. You want to be Munger when you die. You're writing articles about your most famous sayings. That's what you want to be. So I want y'all to be successful. We've had some students that did well in finance have completely changed careers. You can do that as well. But you got to go out and find that thing. So don't find what you love. Find what you find interesting. And then learn as deep as you can, because you're not going to find anything you love in finance. It's too stressful. All right. Any final questions or thoughts for the final? I'll put something out on attendance out there so y'all can see what I have. And then all we got is the exam and the paper tomorrow. Make sure you're watching the video on the paper 3 and 4. It's a good paper to test if you can follow basic instructions in a video, because you just follow that video. Right. So any final questions? Papers 2, 3, and 4 tomorrow. Everybody's got that.